Top Australian growth names are off 30 to 40% from their highs, but the NASDAQ, the growth index, that's actually within 2% of its highs. So it creates this odd divergence that shouldn't really be happening. It's the same global economy. We've got the same growth aspects of two developed economies, but there are huge differences, and it's not the foreign exchange that explains it. It's pretty much flat. So Gary's going to explain what's happening in what seems to be a very strange market. We say strange because commodities have been performing exceptionally well. And the Australian market, the ASX, well, that's a global proxy for risk on into the commodity environment. So why on earth are commodities performing that the Aussie market is down so heavily? That divergence leads us into something critical, and it's the opportunity that sits in front of us in this market right now. It's an important aspect of every market, but even more paramount, even more prominent right now. It's choosing the right sectors. We have huge sector divergence that is happening. And as we know from high inflation environments, this can be the huge catalyst between opportunity and loss throughout markets that can travel sideways and slowly in high inflation environments. So we're going to look at those leading thematics. We're going to look at those leading sectors, which Gary has identified in this week's report. And more importantly, he actually pulls out his favorite names, the ones that he shortlisted, and then he explains why technically he's looking at these companies. It's a lot on your shoulders, Gary, but it is a strange market that we're seeing right now. So what stands out to you in this strange divergence that we're having in the markets?
Yeah, no, it is pretty crazy there that that most of our sort of strongest growth names here in Australia, so I think stocks like sort of Zero, Catapult, 360, sort of NetWell, PMEs, Technology One, just probably high quality growth names. They've all taken a bath here, pretty substantial. So some of them are sort of 30-40% hit, Chris. So some pretty decent sort of declines there, while the NASDAQ is within 1 or 2% of the all-time high here. So it doesn't seem to sort of match up or make sense in some. So I think within the NASDAQ there, you have seen underlying weakness in large parts of the NASDAQ. We're just unfortunately getting the leading names there are holding the index up. It's sort of been going on for a while here, definitely. Maybe last this long, I guess, when you sort of see that underlying weakness and maybe divergence. But some of those leading names there, just sort of, the Googles and, Palantirs and Nvidias, they just sort of held up here, some of those sort of stronger names there. And then their earnings have actually improved as well. So, strangely, you're sort of seeing pretty soft labor numbers there, but earnings in those top companies improving. Maybe as they're laying off and adopting AI. So maybe that's going to continue on a bit longer here. So that's the first sort of paradigm, which it seems doesn't sort of make sense there. So you can maybe explain some of that heavy weighting in the leaders there. The second part is obviously our market has kind of underperformed some of the other global markets there. And we're a commodity heavy market, and commodities are on fire. I mean, gold's on fire, lithium's on fire, copper, palladium, just all, most of the money, not all the commodities, but most of the commodities are on fire here, which is, and so we're seeing a lot of those sort of stocks, doing pretty well here. So, but the index is still, our index has remained under the 50, or was under the 50, 20 and 10 here. Quite recently, we've just gotten above the 10 and 20 here for this little Christmas rally burst here, which we've seen in the last few days, but has been in a pretty weak position, which again doesn't kind of make sense considering that commodities are on fire and we are one of the, you sort of think Australia or Canada are probably the two heaviest sort of resource-based sort of markets there. So so just a lot of unusual stuff there, but I think it's never been more important. So it's not so much the market itself there or individual names there, but I think the sector specific, that's the secret sauce at the moment, Chris, is being in the right sector. You can put all the other things aside here right now. Look, like we know, if you're in those strongest names and you're in the right sector, then the odds of success will double. But I go to always suggest that maybe they triple right now, because the sector seems to be driving everything, and everything's sort of quite momentum oriented as well. So the sectors are running longer and stronger than maybe they have them than they usually do. And that is actually something which does occur in high inflationary markets of the past. They're like the 40s and 70s, they might have sort of stood still over the, the 4-8 year or a longer period there, but they had some big, wide ranging trending markets there where we saw some big moves down, big moves up, big moves down. So that was driven a lot by sort of certain sectors in those markets there. So, I think at the moment the secret sauce is to be in the right sectors there. So you're going to be making sure that you're not buying isolated names on themselves. I think, if you're buying in a sector which is pretty robust there, starting to show its hand, then that's probably the key there. I mean, look, I have spoke about that oil to gold ratio at the moment, and pretty interesting there last night. We've got gold gone to an all-time high there last night, while oil made like a 1 year or basically like a multi-year low there 2 nights ago at the same time. So you got two sort of commodities there, which are probably the two most often traded and followed commodities really in the market. They're at opposite paradigms here at the moment. So pretty interesting now. So I've definitely got I know those gold stocks there, and gold there up about 144 calendar days from the last August low. So that's a bit of a timing to keep an eye on. That oil price went to a margin new low and has bounced down that low quite nice there last night. So just interesting there that we've got historical sort of extremes in that oil to gold ratio. There a little bit of timing here, but just interesting there that we've got margin new highs. And that's something we saw in those 40s and 70s sort of style markets there. We'd see big moves, go back and retest the high, sell off, go back and retest the low, rally again, but go back and test the highs. So they had these big, wide-ranging markets there. So just interesting there. We're at a bit of a key junction there. So those are sort of two sectors to watch pretty closely here. So to see where the gold can continue on. I mean, the momentum so far has amazed me how strong it's been. But at the same time, that oil momentum has been pretty weak, and that surprised me how weak that's been as well. I think at some point they will get a swing, and that swing will be not a daily swing or a weekly swing. I think it's going to be a multi-month, potentially a multi-year swing. So once we sort of see that confirmation of that, I think that'll be worth following here. But so far the market's showing that momentum wins and momentum leads. So you got to stick with momentum here. But we are potentially at could be at an important turning point here, I guess, if you look at those extreme sort of cycles at the moment.
Well, I guess that fits into your point. In this week's report, you talk about the importance of sectors that we've touched on, and those cycles that you're talking about, gold, oil, so precious metals and energy, sort of having an about phase and swapping or switching pairs, however you want to look at it. That's just typical of what you've talked about in the 40s and 70s, of the strength of those cycles and the strength of the sectors ebbing and flowing, 30, 40, 50% movements within sectors, huge changes. So we want to jump to that part of your report where you talk about the sectors. We'll quickly scroll through these charts. Anyone who wants, they can pause and have a look at the charts and Gary's notations, because we're not seeing too much of a variation between these charts. You've talked about sort of the aspects that are happening and the key levels that you're looking for. What I noticed is that you've talked about some of them just being, say, for the Aussie, 4 days, 4 weeks down, and then 4 weeks up. Well, we haven't actually gone halfway through the range, so that's not positive.
Yeah. Well, we are a bit of a, I mean, like you normally sort of see that, like I know the Christmas rally hasn't been as dominant the last 3 or 4 years. I think we've only probably seen 2 out of the last 5 or something, or maybe 3 out of the last 5 sort of, we've had a few aggressive down Christmas rallies as well, Christmas or non-rally, but it is, seasonally this is a bit of a buoyant period, and coming into a midterm year, which is next year, Chris, as well, historically seen markets stay buoyant until January or February. So I think that NASDAQ chart is pretty interesting there, because we've sort of fallen short of the major, of that multiple. See how like we've expanded there. I think this is sort of coming out of this is the GFC sort of expansion there. And then each leg up has been an important expansion point there. So we fell short of that level here. So I just think, with that sort of congestion there, we've always got that sort of little bit of a topping increase in volatility occurring here. Maybe we're going to mess around here, chop around until sort of at least January, maybe go back and retest that level or go and mark that level just above 24, about 24.2. That'd be a level of, probably if I see that in January there, that might be sort of something to heed as well. So, and the S&P's just fallen short, and I think the Dow's just a bit short as well. Our market's been a bit weaker, but we're sort of shopping sideways there. So I think we'll make a right shoulder here or something as well. So, does seem like we're probably going to get a little mini Christmas rally here. And, if we do there, just typically you don't really see, markets normally run through to the first week in January, Chris, because that's usually when a lot of people are away. So, and if the instos are away, what that means is there's less sort of institutional type trades going through, and really our instos are the biggest sellers rather than retail. I know the retailers are scalping and stuff here, but in terms of actually having a bigger effect on market, bigger moves there, the instos are probably going to be the ones who push markets down if they start selling here. So that's if they're away here. That
Don't hear sell.
Yeah, that might not occur until sort of maybe the second week of January. So I just think the market's going to be probably messy till that period here.
Okay, and then if we look for the strength, so you're showing relative strength. That's what you're highlighting here with the biotechnology stocks. This is a sector, and the history tells us, and what you're telling us right now is that sectors are the secret sauce. We need to be focusing on where we see that relative strength, because a similar opportunity in one chart that's not in the strong sector versus one that's in a supported sector, well, that can be 2 or possibly 3 times better for us from a trading perspective. Laying that foundation, we need to identify the theme. You've done that for us, and then find the leaders within that theme and the charts to trade. So you've filtered it. You've put Clinuvel in this week's report. Why Clinuvel?
Well, I noticed that relative strength in our market here, and also in the US too. There's a lot of people talking about the biotechs here this week. Even sort of Stanley Druckenmiller's actually put a few biotechs in his. He's a very concentrated sort of smaller name sort of holding there. So he's got a few biotechs as well, which he's added here in the last week here. So just notice that sector is sort of holding up pretty well here, showing a bit of strength there. That CUV there, I mean, that's you've got that massive descending wedge there. Kind of reminds me of one that I saw a long time ago on Flight Center there, going back probably 10 years ago. I know, probably showing my age a bit. But it came out of that and sort of built similar to this, and then started to recover here. But did a nice little tightening pattern there. Got a little B-wave break here last week. So even on the weekly sort of setup, breaking above that lower high there. Yeah, good volume the last 3 or 4 weeks as well, Chris. So clear signs of sort of accumulation, taking place here. So this stock's got a lot of catalysts here next year as well. So going on to the NASDAQ. So it's already, I think 25% of its holders are already US based. So gonna go be multi-listed there, which will probably
Liquidity opportunities.
Yeah, we'll see biotechs trade a lot more aggressively and probably higher multiples than they do in Australia here. So that it could be a positive for them. And they've got 2 trials coming up as well. They've got a small trial, I think around mid-year, and then they've got a big trial coming up probably around the 3rd quarter of next year as well, which could be a game changer for the company in terms of sort of sales there. So yeah, there's a long way to run there for those things happen there, but there's just some interesting catalysts for this group here. And I think it's 6 years of actually back-to-back increasing profits there, and it's pretty well managed biotech too. It probably hasn't been as sexy as some others with huge growth there, but it's had solid growth, managed its costs pretty well, been profitable for 6 years. So it's actually, I noticed,
Rare.
Yeah, you'll notice. I think I was just trying to think of who the guys. There's a research guys who just won't touch a company until they've got 5 years of data. And so I noticed they were looking at it here in the last month or two. And it's like, okay, they're a pretty conservative sort of group here, looking at a biotech with 5 or 6 years of profit under the belt. So yeah, it's interesting biotech. I think this is definitely one to keep an eye on in 26 there. Sort of, you got Mesoblast is the other one, which is pretty interesting as well. So it's already sort of had some game-changing news and started to increase its, revenues, profits and stuff there. So, Mesoblast is one that's been leaking, had to go to the market a lot here now. It may just sort of reach that commercial sort of status there. And I just, people won't remember the stock here, but there's a stock called Certex, which sort of took about 8 years to reach profit, to get sales and get commercial. But then once it was sort of started making money, well, it really started humming. So, that's why you got to sort of keep an eye on those stocks here once once they hit sort of commercials, just because with the nature of biotech, so the risks are pretty high. So if you are successful, the margins are pretty high as well. So if you do make, if you do make it to commercial status there, then the margins can be pretty exciting. If and that's got to be that way. Otherwise, there's
no incentive to run the high risk.
Yeah, because like majority of biotechs, we'd say probably at least 3/4 probably fail here or don't succeed. So if you do make it, you've got to have a sweetener at the end of it, from an investment point of view.
Definitely. And another one in that space is Polynovo, PNV. I like how you say it looks like some of the uranium names. So tell us how you're connecting these two together.
Well, uranium's sort of been building, but each pullback it doesn't sort of have that flat sideways correction, which we love to see from a momentum point of view. Like if you're trading momentum there, you want to sort of see that fast move up and then a tight congestion and then another move, like that high type flag sort of style. But we're seeing, with uranium, there's, it's a bit like gold as well. Gold can have those sort of deeper pullbacks, and uranium definitely has those deeper pullbacks there. But we're seeing Polynovo, again, we're having those deeper pullbacks into the range. So we're sort of, it kind of almost reminds me of the sort of resources there where you, like an industrial will sort of rally $1 and they pull back 50 cents. Whereas the resource might rally $1 and pull back 75 cents. So it'll come back 3/4 of the range. So we're pulling back quite deep here. But we are building here. Sometimes that sort of, when you're in the early phases there, you will get that deep pullback, and that's kind of more like basing sort of characteristic. But if you're holding the lows in place and building, that's kind of constructive as well. So those uranium names got that same look. And just seeing them pop here to new highs. Some of those have gone new highs the last couple of days here. But this has sort of got this sort of similar look here as well. But definitely a sector to sort of keep an eye on here as well, just because we're starting to see some of those names sort of permeate. And it's a bit of a hangover there from COVID, with a lot of those healthcare names. And all the biotechs were basically shelved through COVID there. So, you're starting to sort of see bit of a backlog of maybe some of the stronger names. So starting to get some traction there. So definitely a sector to be keeping a close eye on here in 26.
Well, changing the gears to have a look at those strong growth names that you talked about at the start. Technology One, it has had phenomenal success. So we're looking at the weekly chart here. On the far left, we're looking at $12 a share, and then right up here, 44. So no disputing massive growth. Had sideways base and formation, which is more volatile than what it really looks on this chart. On a log scale, we'd see that. But an explosive rally up, does pull back, overbalance the trend, but then shoots off and has that huge climactic rally. What we're looking at here is this congestion, which goes for the best part of, 6 months of this year, traveling sideways, and then seems to have fallen out a bit. What happens here, Gary? What do we learn from this chart, and why have you chosen to put it in this week's report?
Yeah, I mean, obviously we know the sort of 50-80 rule. We know sort of a lot of those, like 80% of those growth names will come back around that 50%. And then we sort of know, maybe 50% of them might come back, say 70 to 80%. That's kind of the rule of thumb there for those sort of leading growth momentum sort of shares in. So pick ones, is a leading sort of growth name here as well. So they're probably slightly more conservative there. So you may not get your 50%, but you'll go probably pretty close. We're probably already pretty close already. But I just noticed there that when you've got those accelerating trend lines sort of running there, they'll often come back to where the last drive sort of started if we have. And I think the Technology One has sort of built 3 or 4 ascending trend lines in that move. So that's the level to sort of keep an eye on there. So should come back pretty close to that. So yeah, it looks pretty oversold here at the moment. Maybe we'll get a little bounce there, but I would wait until I sort of see that level, or get pretty close to that level there, just looking for some, price action around that. So, yeah, I mean, it's good companies out there. Look, maybe they'll bounce there. We're obviously getting a little Christmas rally here, but history's sort of shown that you're better off waiting for those wave 4 zones to be, that last acceleration point to be hit before you jump in there.
Well, Catapult's another one that did have those accelerating trend lines. Fortunately, you've drawn it here on the red. So I'll just quickly highlight some of them for those watching on their phones, smaller screens. We're getting the lows that are linked up together, another low which gets a bit steeper, more lows, it gets steeper again, and then the final one, it gets very steep, going from $3 up to north of $7.50 on that last red line, getting very steep. This is that accelerating point that you talked about, a last accelerating trend point, and it was similar to what we just saw on the chart. So is this acting like a magnet and trying to drive the share price back to this $3 level?
Yeah, just from my experience, I'm a little older than most, and been around a bit, and just studied this sort of cycle over, I guess through quite a few sort of bearish phases and stuff there. So I'd just be hesitant about trying to buy these growth names too early there. That's probably the earliest I'm probably stepping in around that mark. So from my experience, sometimes they pull up just shy, or maybe they just slightly overshoot. But yeah, it is a bit of a magnet, just from what I've seen here. So yeah, I wouldn't be trying to buy some of these, great. I mean, there's some great companies there. Still likely to keep growing here, but just history sort of shown that that's probably the level to wait for.
And there was a great quote you shared with us, I'm going to say last Friday, but it was about these great companies, and they do get to massive elevation of price to earnings ratios, valuations. The share prices get super lofty. And he said this really well. I think he might have been quoting Minavini saying, it's not that they're bad companies. It's just they get overstretched and the price gets too high. It's not that something sinister is happening in the company, something's turned bad or poorly. They just overshot the mark on the upside, and they sort of come back to what would be sort of like a normalization or a baseline. So it's not like you're saying these are bad companies. It's just that they're not favorable trades. So even if it comes back to here, it's not like the company's going under or anything like that, is it?
No, I mean, I think Coca-Cola and McDonald's have had 70% declines in their history. So, that just shows you that those growth names, the companies that grow, or some of the best companies as well, can have those, bigger declines there. I mean, we saw that Amazon in 2000. That's probably one of the bigger ones you've sort of seen. That, you could probably argue that was one of the best stocks on the planet, but, had a massive decline, bigger than anyone would have liked to have seen. But yeah, just so you can sort of, just those companies can get ahead of themselves, and multiples can, and then when they tip over, they tend to have pretty large corrections. So you get both there. You get the overshoot on the rally. They get super expensive, and everyone sort of loses sight. The fact that they might be each quarter they're producing growth numbers that they're just too good to be true, and then but everyone loses sight of the fact that the multiples are going from 50 to 80 to 100 and 100, maybe 200. And
don't get us wrong, we love to trade it while they're doing that. Yeah, happy to trade it.
Yeah, as you're making money, you're probably losing sight of that. And then it's weird after it drops 50%, you go, oh yeah, that's probably probably makes sense. It's worth trading on 200 times. So, but it's nothing new for these growth names. We sort of know these sort of things do occur here. So, there's the opportunities too. So, we'll see them have some fairly decent sized pullbacks, and then But I mean, I like that NetWell. I think that's a very good company there. So they've still got pretty strong growth edge. Probably more of a market proxy as well, Chris, just because as the more funds under management is in there, the better the company does. And two things drive that funds under management. Obviously, one is growth and more people using it. And secondly is where the market is. So if the market is growing, going up, then funds under management growth, the market pulls back, then the funds under management will take a bit of a hit, and that will slow down the growth. So that's when these sort of market proxies can sort of come back here. So they used to be sort of the banks. Macquarie was probably a good market proxy, but now these sort of wealth management companies,
Even sort of a cleaner.
Yeah.
Macquarie has so many different revenue streams, whereas this is a much cleaner and simpler and easier way to understand the revenues. And they're linked to the market. There's a very strong beta to their earnings.
Well, it used to be Macquarie and ASX, and then it was sort of some of the fund manager the groups, and then so they all separate at some point. Now Macquarie and ASX have got other things going on, so that they're not really following the market like they used to. So these stocks are definitely sort of following the market more closely.
Okay, so on net wealth, I'm going to go on the limb here. It's not my area, but was this A, B, C kind of thing? And then coming back towards, we've gone from one end of this broadening formation to the other end, and you're looking at this to be a bit of a magnet to draw it back into this trend line.
Yeah, I think if we sort of see something, just look, had a pretty sizable pullback here. Just think this is an obvious level there. I think CBA did something like this, Chris, on the way down as well. Made this big, it actually did bounce off of that low, and then made a little shoulder, and then actually broke down later. So even though it actually did break down below that, the broadening pattern, it did bounce there first. So you might sort of see something here. So seems strange here that we're down. There's all our growth names were on there, sort of somewhere on the knees, off sort of 30-40% here, while the NASDAQ thing was high. But maybe we'll get a bounce here soon. And maybe obviously next year's a midterm year. We know that's the risky year for markets. So maybe we'll get a bounce here in the short term, and then maybe we'll see something deeper there next year. Maybe sort of second or third quarter.
We'll look forward to seeing that unfold. But we've got Computershare in your report. Again, this is a weekly report, weekly chart showing massive growth from about 12 months ago to $24, $42, $43, and then getting quite volatile as you talk about the volatility happens at the top or the bottom. But it's been moving down to undercut that low that we saw in the earlier part of this year with the April lows. So how important is it seeing and actually breaching this level and the behavior around the breach? So what do we learn from this chart?
Yeah, I actually love seeing this on a daily sort of setup where you've had that really strong growth, and then you have that sort of ABC pullback, and then you stay in the top half of the move. So to see how, almost sort of coming out of October 24, that's been a really strong impulsive move there. And so, we've had a bit of a crawl up from pullback there, but we're still staying in the top half here. So we're still staying pretty robust there. And now we've sort of made a little bit of a false break of that April low. And that's taken a long time to get down there as well. So a bit of volume stepped in at that low. So that's a sort of setup I like to see. I just want to see a little bit more evidence that it's just not a 1 week wonder sort of reversal there, but definitely going to get 2 weekly bars there, pretty heavy volume. So so could be some accumulation there, but that's potentially a good setup there. We know Computershare is still in that growth phase, having rolled out its business to other markets there. So it definitely looks pretty interesting there from the weekly perspective there. Sort of like, I think it sort of holds the congest there. It's just sort of one to keep an eye on here.
Well, the energy is something you talked about at the start. You've talked about oil to gold ratio, and then you've talked about some biotech companies looking like uranium companies from the charting perspective. Very deep pullback, 75% of the range, that kind of thing. Stanmore Resources was Stanmore Coal. I like to see this in your charts. You've got this purple line drawn in here, and then you've also got this lovely setup here, which quite often I see you highlight, and then it can lead to an explosive movement. So what are you most excited about on this chart from an opportunity perspective?
Look, we've got that sort of cup and handle, which is definitely a setup we see in the sort of strongest momentum names. And we also do, we've seen that. I think we saw it with Nuix. It might have been with TUA in 23, 24 there, where we actually saw the cup and handle, then the cup and handle as well. So we saw that first cup and handle, and then we saw the second cup and handle as well, follow as well. So we sort of go back, can go back to back cup and handles there. That's actually something you do actually see quite a bit in those strongest names. So it's got all the look and appearance of stronger names there. I know like some of these, the only issue I've seen with these sort of energy names is that they have been a little bit more volatile than these sort of the typical sort of growth names. So they can move around a bit more. So I noticed like those uranium names definitely, they pop hard and they pull back pretty hard as well. So but this is a good looking setup here. So we'll see whether it can hold that little handle there. But yeah, I think if it holds that, I think it's around about 232 or something like that, but holds that level there. That's pretty, looks pretty solid there. I think if it comes out of that handle, it'll probably be worth following.
Well, you mentioned uranium, so if you've got a uranium name, Paladin, you've talked about big pullbacks. Yes, there are big pullbacks. It can be volatile. It can be very fast moving and drop away quite quickly. So you've got to keep you on your toes and be stops well managed. You've got ABC written in here, Blanche. We're looking towards the right-hand side of the chart. As I'm noting, the volume has been diminishing over the last couple of months. This seems to be wider than the ideal setup for a momentum play or a breakout, but there's going to be something more to it. So what's the more to it with Paladin?
Yeah, obviously you got that descending wedge on the weekly sort of setup there. We're sort of broken out of that. But now it's sort of, even though it's a little pulling back a little deeper than you'd like to sort of see, we are seeing a series of high lows in there. So we sort of got that first little higher low there, maybe around May, June. And then there's another one there, sort of July, August. Just recently we've seen one here and there's December here as well. So we're just sort of building quite nicely there. And that's, sometimes that's pretty constructive in the early days that it sort of build here. So it'd be nice if we sort of see this flat out here, Chris, just get some, maybe a nice little handle under this sort of, I think $10 is sort of around that high. So we can have a little bit of a pause there. Yeah, to stay nice and tight there. That'll be the ideal sort of setup there. So yeah, we're just, we'll wait and see there, but yeah, there's some just positive signs there, some building signs there. And we can clearly see that it's going to be fairly robust demand for energy moving forward there with all the all the notations and talk around AI and the amount of data centers there. We just saw a data center deal overnight there. So on the big names is Google's bought a data center, its own data center group there. So realized it's going to have its own energy demands. So rather than take the risk, go and buy the business and make sure that they're going to be able to,
Upgraded FOB controls over the key supply.
Yeah, just basically just kind of control their own outcome there as well. So that's pretty interesting. So, it's definitely a pretty interesting space here. So, it's probably the long game there as well, Chris. We've sort of seen with these things, they do chop back and forth a bit, but what you are seeing there is, it's very constructive there, a number of high and lows. I mean, we saw that, to go back and study gold out of that October 22 low, that initially was a little bit loose and we had a few high lows building in there. And then you saw those names start to build some momentum. So, we could be just early in the move here as well with these sort of names. So, just be watching these there, just be patient there. But they do have a habit of pulling back pretty sharply. So that's why you probably don't want to be chasing breakouts and stuff there. I'll be waiting for pullbacks and consolidations on these things. So, but yeah, it definitely looks pretty constructive here longer term.
Well, very good. Well, there's some solid insights to take into the break. And I guess our homework is to stay on top of the thematics and identify which themes, which sectors are showing that relative strength. And then if they're doing it as a group, then you've told us history. It's also told us with your 1940s and 1970s inflationary studies that's going to be our key. And right at the top, you said that's the secret sauce in the markets at the moment, is being on top of those sectors. So for the next couple of weeks, we may not be recording, but the markets are still trading. The opportunities are still there. Is that your Insights
yeah.
share this?
Yeah, I mean, like, look, I'm actually long, a couple of gold stocks at the moment there, just because they've traded, in a pretty strong sort of manner here. So I'm wary of them, running out of puff here. So, but at this stage, it's shown here that momentum is the key. So, momentum markets are, running a lot further than everyone thinks there. So, as long as you've sort of got good, you know, to me, is if they're tightening up and getting low risk entries, and then they're bursting out, we just follow those, follow our sort of our process and stuff there. But yeah, that energy thematic is the one that I'm really keeping an eye on there, because that's sort of we've seen in the past. You go back and look at those 40s and 70s moves there. We just saw some big years in precious metals, and we saw some big years in the energy, and then they can have some big negative years in between those positive years. So we just know that they're big trending markets there. Once those those sectors are are running, they can run for quite a period of time. So we've seen it with uranium as well. Like uranium's had a few big moves here, but it's had a few large declines as well. So why can't that happen to all the different energy thematics and a lot of the commodities as well? So I think we're going to sort of see that. So I think getting along the right commodity, it's probably going to be the most important thing for next year.
I like that. That's a good one to leave us on. Thank you very much, Gary Glover from Novus Capital.
Thanks, Chris.
If you want some more trading education over the break and the Charting Eye Gym, we'll put 2 links there. Charting Eye Gym, improving the performance by bridging it in the back of the brain, the retina, so that you identify the cups and handles and all the patterns that Gary's talked about. And then the trading setups and trading education lessons that Gary and I have learned and he's shared with us, so that we can become better traders.